Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Today we have an exciting day coming up, really just in terms of putting some thought towards what's been going on with respect to some of our price action and finally reaching some realizations here with some of our IV infelicities and their relationships to expected interest rate changes, right? We've talked about some of that in the context of the Bank of Japan. Now I'm starting to think about that, especially thanks to work of some of the broader community on its relationship to U.S. federal funds rate changes. So we're going to be taking a look at that today. Before we get into that, we obviously have to get into our gratitude. And that's going to start, of course, with, once again, GME Sure Why Not, aka Feck It Be Grand, sponsoring today's newsletter and video breakdown, as well as to our monthly contributors, Dat Scruffto, Ken Wedmerland, and Not Medical Advice for offering some support to offset some of my data expenses on a monthly recurring basis. Thanks as well go out to everybody who has supported in the past, will support in the future, either in terms of buying me coffees, offsetting data expenses, or just leaving good questions, comments, expressing appreciation, something like that. All of that is very much appreciated. So my thanks go out to you. So today, definitely thinking about this past couple of days, been thinking about this really, really excellent post that's been put out by the Ultimator 5. So he put this out about 2 days ago over on Reddit. What this largely amounts to is a discussion about how institutions not only hedge swaps on GameStop, so hedge equity swaps, but the sort of second-hand result that institutions, prime brokers especially, who hedge equity swaps, end up also opening interest rate swaps, and how their portfolios end up very much extremely leveraged as a result of these interest rate swaps, and how even the slightest change, small changes in interest rates that have to do with federal banks or national banks across the world can have drastic implications with respect to shifting portfolio balances. So I'm not going to break down all of the Ultimator 5's post today. You can go ahead and read that. Of course, I have it linked here on my article. You can go ahead and just read the post directly. But what this basically got me thinking about over the past couple of days was like, how have these historic interest rate changes, how has this affected GameStop, right? We've talked about how when we've looked at Bank of Japan interest rate hikes, this has often corresponded to a dip in GameStop's price action, right? So we've in a moment, I'll demonstrate what I mean here. But what really happens with the U.S. federal funds rate as far as GameStop, and is there some correlation between repositioning with respect to these interest rate swaps and notable price action in GameStop? So that's what we're going to start off thinking about today. And I'm going to extrapolate essentially what I've come to understand from that into what I'm expecting into the next few days. So in the short term, and potentially what's going forward into June and July, and maybe even later. So that's what we're going to be thinking about today. So first chart we're going to look at here is history of the Bank of Japan rate changes, right? Okay, so the last 3 dates where we had rate changes, they were hikes. Okay, so this is March 19th, 24. These are July 31st, 2024, and January 24th, 2025. So these took place this year. All right. So I was like, okay, well, we know, right, there was this much popularized one that had to do with July, right? So here in the midst of July, right, we remember the Nikkei crash and whatnot, but I wondered, okay, does this have some sort of correlation otherwise? And what seems to be the case is that 1 week prior to this rate decision, we have bearish activity in GME. So here's 1 week prior. Then we have the rate decision. And then for about 2 weeks prior, we, throughout the course of the past trading year, right, we traded down. So this was after March. So 319 came in. We had just traded down for a week. We got this brief earnings, which may have been a swap related thing, sort of reprieve. And then we got shorted down again afterwards into the April bottom at 995, 996, 995. And then, of course, we came up after that. All right. Then we had BOJ on 731. The week before that, right after July OPEX, we came down pretty hard. And then we went down super hard immediately after we got the rate decision. Okay. We kind of continued. We didn't come down as much, but we kind of stayed down. We bounced and then went down before moving back to the upside. So, okay. So about a week before, and then for about a week after, bearish, definitely surrounding the 31st decision. And then the 24th, for about a week before, super bearish. And then generally for about a week after, also pretty bearish after we got the 24th decision. Correlation's not super tight here, but about a week on either end, maybe a little bit more, but a week on either end. These also tend, these have seemingly been connected to other maybe swap related elements here. So the July event may have been related to August swaps, right? We know that the March event was related to April swaps, and January may have been related to the early March swaps as well, as getting the price down with respect to OPEX maybe here just before this. Okay, but there does seem to be this correlation that about a week before and a week after we got the rate hikes, we got some pretty bearish activity in GameStop. All right, but what about FOMC? Okay, what did we get? Well, we had these dates over the last year. So September 18th was the first cut we got. It was also very surprising that we got the 50 basis point rate. So that was not necessarily anticipated. I think around 25 was what was anticipated, and we got hit with a 50. November 7th, 25, and then December 18th, 25. So I thought, okay, well, what does this have to do with GameStop's price action? Do we see something similar like what we saw with the Bank of Japan rate hikes? Do we see something, say, inverse? Or when it comes to rate cuts with the federal funds rate? And so if we go September 18th, right, we got our 50-point basis cut there. 2 days later, ka-chow! We got that huge volume day right on September OPEX, so that was likely unexpected. Huge volume day, big up, and which lasted all the way into the 24th of September. It continued to move up for a little bit, but this big up move all the way up to 25, basically by the beginning of the next week, and then we traded down thereafter. Excuse me. Okay, right. So we were scratching our heads. What was really causing that volume? Is it possible that volume that we saw come onto the tape, that 62 million volume on the 20th, was related to this unexpected, this surprise, this uncertainty with respect to the Fed funds rate change? Very possible. If that's the case, that might also explain why Ryan Cohen decided to do that 20 million share offering back on September earnings. He potentially foresaw there being some volume that had to do with this rate change. But okay, that's just one example. What about the next one, 11.7, 25 basis points? Well, next day and 2 days later, what do we get? Huge upward move, big upward move. Next 2-3 days, lots of bullish volume, right? We can see it on the chart here, lots of bullish volume. This was probably the most exciting part of our upcycle here, right? So of our December run, that's most of the appreciation in that run. At least half of it is attendant to those couple of days following that rate cut decision on the 7th, right? So we can see the 8th bullish day, but then the 11th, 12th, 13th, right? Big bullish days. And then the 18th. Okay, so this was 1 week after Q3 earnings. There was not an at-the-market offering. But, right, you'll notice just prior to this, right, we had kind of moved up to 32 again. It looked like we were going to double top. And then we got the rate decision there, and then we went up to a new high and then did the real double top here, right? So we could have done this 32 double top. We were continuing to close weeks below $30. We did not get our first close above $30. I mean, in years, it was the first time since I think 2022 that the price closed an actual week above $30. That didn't happen until we got this rate decision on the 18th, another 25 basis point rate cut. So, right, and that was the 20th, 2 days later, was December OPEX. That was also triple witching. Basically, that entire trading day was defined by a massive VWAP order that just got punched in at the beginning of the day and went until like 3 o'clock. It just punched in the whole day, and then that following week, no, even that week, I think we still closed below 30. The following week, so the week of the 26th, that would have been 26th or 27th, I think it would have been December 27th OPEX, was the first day we had an options expiry close above $30. That happened for the next 2 weeks. So bullishness continued right on the 27th, 26th, 27th is when we got our kind of test of 35 there, or at least our punch above 34. We came back down, did a double test, and then came down pretty hard. So very interesting to see this basically scattered through this kind of up move here. So to what extent was this price up cycle actually the result of these rate cuts? Or how much of what was going on here had to do with, say, interest rate swap rolls repositioning that resulted in bullish volume coming onto the tape in large proportion in GameStop? So very interesting. And noted, right, we've had nothing basically since then. We've had nothing since then. Right, and this may also explain, right, this sort of action was what was keeping us basically off of our kind of cash floor baseline out here, right? So we kind of see this, right, even with this huge upward price event back in May and June, right? We kind of come back down here, get the at the market rate. So this is very much this 2x kind of cash floor, and then right. So we came all the way back down here and then come up. Do we get another rate cut here? Is something going to happen with respect to interest rate swaps now? That's certainly something worth questioning. It does look like these interest rate decisions do play a role in seeing, let's say, excess bullish volume in GameStop. So something that really kind of takes us off the needle, right, with respect to that cash floor there. So very, very interesting. So if we take a look at interest rate forward projections, we can take a look at what the Federal Reserve is estimated to have as the probability of rate cuts. So the probabilities heading into today's trading, right? This is why I'm thinking about this today. Today is an FOMC rate decision day. We have a very low probability of any budging on the rate. There's about a 3% chance estimated that we will have a rate cut of about 25 basis points, 97% chance we stay where we are. Okay, interesting, right? So very high probability, no real change there. Okay. As we go forward, June 25, we've got the probability of staying where we are at 70%, 28.6, we do a 25 basis point cut, 1.2%, we do a 50 basis point cut. Interesting. July, as we head out to July, right? 25% chance we stay put, 55% chance we get a 25-point cut, 18.7% chance we get a 50-point cut, 0.7% chance we get a 75-point cut. Very interesting. Okay. This immediately brought to mind some of these strange figures we've been seeing in our IV. If we go out and take a look at our IV chart, what do we see? We see that, okay, why are May options so low? Why is this the case that we're seeing? This is not very common for a price up cycle. What's going on there? What we see is, okay, low IV for May. Could it be that implied volatility is lower for these May options expiries now into the first kind of 2 weekly options expiries here in June, maybe with the exception here of June 6th, which right now Thinkorswim itself is estimating as when we'll have earnings. I don't know if that's going to be the case. But then if we look ahead to June OPEX, so this is right after the Fed rate decision. Fed rate decision in June is going to be on the 18th. And then if we look ahead to July, the Fed rate decision will actually be after this. It'll be slightly after. It'll be on the 30th of July. But then October is also very high. So what is going on here, right? what do we notice? IV is very much elevated in these current expiries right now. So I would propose that the reason we're seeing these IV discrepancies has to be the fact that the later we go in the year, the greater the probability right now is estimated that we will get federal funds rate cuts from the Federal Reserve. So if this is the case, it makes sense why we would see IV priced into this, given that the probability that GameStop will see bullish price action in relation to these rates, to these rate cuts, increases. Okay, that may in fact, right, solve our IV question. So what does that mean, right? What does that mean as far as going into today's price action? What does that mean about the continuation of our bullish upcycle? What does that mean about going into June? Well, I would say overall, right, what seems to be the case, we'll break this down in our data. It seems like a small probability, right? So we know that big bullish volume pops up when we get a rate cut. Okay. There's a very small probability we're going to get a rate cut today. It doesn't mean it's impossible, right? 3% chance, wherever that probability is actually derived. If we do get a rate cut, I think that is likely projects to an influx of some decent bullish price action in GameStop based on what we've seen heading into the end of last year. So if in fact part of what gave our price up cycle, this late November, December cycle, if part of what gave it this really sort of huge divergence off of especially that $30 price level was in fact these rate cut decisions, then that may be a necessary component to see that kind of continued price appreciation in GameStop without kind of just sort of hanging out in the this kind of mid to lower $25 to $30 bracket, right? We haven't really even gone much beyond $28. If not, it may still be the case that we get some bullish price action with respect to the actual repositioning of these swaps, right? So even if there's no decision today, right, that may affect how the swaps are priced given the uncertainty regarding those particular rate cuts in the future. So interest rate swaps may be repriced, and given that the probability that a rate cut happened later rather than sooner, under the circumstances that we do not get a rate cut today, this may result in something of a mild appreciation in GameStop's price as portfolios are rebalanced to account for the new possibility, the adjusted possibility or probability of rate cuts at one Fed meeting this year, later on in the year or not, right? So those later probabilities will change based on what happens today. So there is probably some chance that there is an appreciation rate, especially if those probabilities go up because there's no rate, because that's basically what that says. If there isn't a rate cut today, it means the probability of rate cuts happening later in the year goes up, right? Because they won't be happening now, right? So there may be then an interest rate swap sort of repositioning, rebalancing with respect to that on the part of some of these larger brokers, right, that have these interest rate swaps in order to hedge equity swap positions. Okay, so do we see what do we see happening in the price action? Do we see anything that might suggest, from our technicals, from our options, from taking a look at daily price action that might suggest somebody is preparing for this? Let's take a peek. So yesterday, right, what we saw, which was I would say heartening, was finding support down there at the that 2570 historical level. So throughout April, we tested that level 3 times, and it held. We got this kind of triple bottom kind of formation here intraday, kind of mirroring what happened throughout April. We did slide down. So you'll recall yesterday's article, yesterday's video. I said that, there's probably something to that, right? I mean, I don't necessarily I don't get excited whenever I see kind of muddled options data or muddled technicals, it kind of tells me, I think we're going to slip, right? We didn't plummet because things didn't look, god awful. But muddled data didn't have me feeling good. That was kind of my intuition going into it yesterday. Take that for what it is. But what was really interesting was then once we showed support there at around 2570, we got some very interesting options activity. And I want to take a second to break this down as well, because I saw a lot of questions out there with respect to this particular options move. And I thought I'd break it down a bit and sort of point out why this trader may have gone ahead and done this trade, say, as opposed to just buying shares, right? Because what this trader ended up doing was selling 2,600 contracts, 2,600 deep in the money put contracts with expiries for 16th January 2026. So when you're that deep in the money, right, they were $95. They were $95 puts that were sold. So this trader collected around 18 million in premium, and had to set aside about 6 million in 6 million in credit, right? So 6 million in collateral. So collected about 18 million in premium and set aside 6.7 million in collateral in order to keep this position open. So why do that, right? I mean, if you've got this 6.7 million in collateral, like, why not just take that? Why not go out? Why not buy shares with it? And I think this has something to do with the relationship between this type of trade and either the equities market maker or the options market maker. So as we can see, right, what happened when these trades came in, so we can see the time that they all came in, basically throughout the second half of the day, but up to kind of leading into 145. After 145, we had a bit of a lull around 245, and then again at about 315 we had another wave, and then right on the close we had another wave. So about 3 waves. The largest was the first here, and we can see the effect there. So the first one came in, really just kind of rocketed us up over VWAP. Then we traded down a bit, kind of scrubbed on top of VWAP, then got picked up again into the close, and then closed pretty close to VWAP itself. What was going on there? Well, in order for the options market maker to remain hedged, the options market maker had to go out into the lit market and buy approximately 260,000 shares in order to delta hedge this position, right? So this trader going ahead and taking on these 2,600 contracts onto his books meant that there was positive delta on his books. So it meant that there was negative delta on the books of the counterparty, in this case, the options market maker, which the options market maker had to hedge by purchasing long shares of the underlying in order to remain delta neutral, right? Because it was a 1 delta contract, it meant that every single share that this contract mapped to had to be purchased. Okay, so why was it the options market maker that had to do this? Well, of course, because there were options contracts involved. Why didn't, say, the options market maker go ahead? Why weren't all of these shares bumped to the dark pool? Right, we've seen that take place with large share orders in the past. Well, number one, that may be a reason why this trader decided to go ahead and do this sort of deep in the money short put trade versus going ahead and buying the actual long shares. So if this trader said, okay, I want command over 260,000 shares of GameStop, I'm just going to go ahead and buy them on the market, right? What would have happened? Well, what happened the previous day? What happened yesterday when we saw blocks like that come in? The equities market maker internalized the order, sent it to the dark pool, basically delivered an IOU, and then, we saw nothing essentially affect the price of the underlying, right? So none of that authentic buying demand actually made it onto the tape. It didn't make it onto the lit market. So if this individual came and just dropped a block of 260,000 shares, pretty good chance, based on how the equities market maker has recently been treating those orders, that was just going to be internalized. It would go to a dark pool. The person would get their shares, but it wouldn't affect the price of the underlying as it's available on the lit market. All right, by sending this to the options market maker, the options maker, a market maker had to hedge this. So the options market maker was the one that had to go out and actually buy these shares, not the trader opening the short put trade. All right, but wait, why wouldn't the options market maker then just bump it over to the equities market maker and just internalize the trade? This has to do with the fact that this trader in particular did not enter all of this as one solid block, but entered this in increments of 25. So just whoever this was just started punching in various orders at increments of 25 across different time frames. So these are all at different times. These are separated by a few minutes. So it meant that this was a small order coming in. The options market maker was hedging these orders a few shares at a time, right? To have to hedge 2,500 shares is not a lot of shares. If you get it as one big block, right, okay, I'll just bump this over to the equities market maker. But the algorithms will just go ahead and instantly hedge a 2,500 share block. They're not necessarily going to bump that to the equities market maker or bump that to a dark pool. So it really seems that this was done by design. And in particular, what was interesting about it is by doing this, by the very fact of entering this trade, right, it caused an appreciation in the underlying. So by entering this trade, this trader appreciated the value of his own position by the very fact of its execution. Very interestingly, of course, in relation to the options market maker. So very, very interesting to see that come through. That's a pretty bullish trade. It's not a bullish trade with a terribly close time horizon, but very interesting to see it come through at this point, at this historic level, and then sort of lift us out of that. And of course, we have been seeing some bullish price action. We saw it in the after hours and then in the overnight market as well. So very interesting to see that happen. Okay, we see an interesting options order like that tends to skew as a bullish signal. What about technicals? What are we looking at? Let's see. In terms of like liquidity. Liquidity is not optimal, I would say. I mean, lending liquidity, that is, if you're looking for, say, bullish price action, it's very high. Okay, GME shares available, very high. XRT outstanding, it's coming back up. It's at 5.35 million, not dollars. That's a typo there. The borrow rate is down. It doesn't seem to be doing. So if we bump over here, get a quick refresh. Oh, it did its little 715 thing again. So it did do that again, very interestingly, and came down. But now we're at just kind of before open. We're at 750,000 shares available to borrow there. Very interesting, right? How are we looking over on GameStop? 3.9 million. So yeah, pretty high. Okay, so that definitely tells me that tools are in place to control the price, reasonably. Should some sort of bullish externality, should we get some of this buying pressure to kind of come on the tape today, tomorrow, the next couple of days, right? The lending liquidity is in place to be able to contain this. All right, so not super bullish. It doesn't mean we can't get a sort of a bullish move in the underlying over the next couple of days. Today certainly, but that it doesn't seem to be that even if we do, that this would kind of get out of control. The tools are in place to control the price. What's interesting from a technical perspective, Ultimator's bottom finder here. So, right, Ultimator has a number of scripts, a number of tools he's developed over on TradingView. Took a look at this yesterday, and during our trading, so this is over on our 4-hour chart, bottom finder basically gave a value that sensed a bottom that was greater than basically anything we've seen in the past year. It was greater than, but very close to the sort of signal we saw just before earnings, so around the 19th of March, which is when we got a Bank of Japan decision there, and then one at the end of August. So this kind of just before we went on this big move to the upside here. So after the last indication, right? So we got this earnings related spike. We got one last time we were this high, right? So we got this kind of up move into Q2 earnings, and now this, right? So some of these smaller ones also have corresponded to moves to the upside, right? So this one definitely did. The one back in March definitely did. One in February definitely did. The one in January, a smaller move, but it definitely did here. So we kind of bottomed here, got this smaller move. So, I mean, it doesn't guarantee a huge move, right? And I should point that out. It's also not proportionate. It doesn't look, if we look back here, it's not proportionate. This one, then, this was a bottom here back in late October. And that seems to have resulted in this kind of horn here. Late September, we also got one that was connected to that, was just prior to the federal funds rate on September 18th, that decision, and the big move on the 20th. So it's pretty good, right? When we get these spikes, we do tend to move to the upside. We move pretty hard to the upside, like within a couple days. That's certainly been the case over the past year. Now, it doesn't mean we go into a big bull trend that's going to last weeks and we just explode and it's going to look like this. No, right? No. Like I said, they're not proportionate too. So, for example, we did get a signal when we bottomed at 995, but it was pretty small, and then it resulted in a shot up to 80. So over the next 2 weeks, so these do generally correspond with a move. They're not proportionate. I mean, move to the upside. They're not necessarily proportionate. Though while we've been in these sort of bullish circumstances over on GameStop, these have been pretty reliable. Just to kind of toss that out there. So, I mean, obviously exercise caution, but that's a let's say the utility of taking a look at this indicator is non-zero. I can say at least that. If we take a look as well, we do have an indication over from, so Richard Newton's been playing around trying to build a model of price action that takes into account ETF creation in relationship to the net asset value floor of GameStop. So essentially based on the value of largely GameStop's cash reserves. So if we do look at some different variants, he has a couple different models here. You can go check out Richard's page in particular. Go check out his videos. He does talk through this in greater detail, but it does suggest he has multiple models that weight certain factors differently, and most of them, all three of them, right, are projecting some sort of move up. Basically now, right? Basically into the next couple days. Now, again, I'm going to say exercise caution here. It's a short-lived move up. It is a move up that does seem to be correlated to ETF activity, but it also looks like it's followed basically into like the middle of next week by a fall off a cliff down to about right now it's sort of projecting 24. I mean, again, take this with a grain of salt. Even Richard himself said this. He's working on this is a work in progress, but interesting to see that the model currently also sort of projects something coming out of today, either directly today or the next couple days, that suggests some sort of dynamism to the upside. Very interesting. If we look at just kind of our pure classical technicals, not splendid. The 4-hour did look good, right? So we took a look at the 4-hour chart. I mean, even kind of those up here, right? Right. So we got this deepest indicator from, or this highest indicator from Ultimator back when we touched the 104-hour moving average, which is a good sign. When we move out of that range, we go to our daily and our weekly charts. Not amazing. I mean, the correlation here on the daily chart is not supreme. It does look like, I mean, if we're relying on this chart would suggest, we're kind of uncurling here. We're about to get a bearish cross on the PMO. I mean, maybe we get something, right? Maybe this is what ends up kind of knocking us up here. Right. But it does say like, probably listing down to about 25. That's what our daily chart tells us. Weekly chart, kind of slipping down, right? Yeah, we slipped down. We closed just below the 200-week simple moving average. Again, not splendid. We did, I think, go ahead and touch. Yeah, we did touch RSI oversold yesterday. So that's where we reversed and got really close, basically within a few cents to the 200 simple moving average here. So, I mean, the 4-hour chart has a lot of reversal signals that we're seeing. Daily and weekly, not so much momentum, not so great. I mean, again, it's not crazy bearish, but it's just not saying like, oh yeah, we're definitely going to explode. Not on those time frames. That's not to say that things don't look, It's not to say that right, we're going to necessarily move violently to the downside, but specifically on these charts, there isn't anything from a classical technical perspective that suggests some kind of imminent move to the upside here, right? So a little bit different, right? We have these kind of alternative indicators that seem to be showing us the possibility for that type of move. These time frames, not so much. So I'll digest that in a moment. What's really interesting, actually, in addition to this, so we talked about this really big deep in the money put order, right? I mean, that massively shifted us in favor of a bullish day here. So right, this is perhaps the most bullish day in terms of options premium purely I've seen. I don't know. Yeah, basically since last November, I want to say. So pretty crazy bullish there with respect to those put orders. What's really weird though is in the short term, basically everything we're looking at, right? All of our major shifts in OI are all bearish in the short term, but bearish in a particular way in that they are short calls, big blocks of short calls. So I decided to dig into this a little bit to say like, okay, like, is this just broad trader sentiment that maybe number one, right? I would think, okay, is this skewed towards the beginning of the day? Was this to capture this down move off the open, right? That would have been pretty profitable if these were traders opening short calls sort of earlier in the day, and then sort of sentiment shifted later in the day. That would be one thing. Or, is this just kind of overall bearishness sustained throughout the day, kind of heading into the end of the week? And it turns out none of the above. So most of these short calls that really affected our OI balance yesterday all came in basically at 245. They all came in at 245. So all these three blocks here, this whole block of stuff, all came in at 245. So it was coordinated between a bunch of different strikes, thousands of contracts right at 245. So 245 at 26, 26.50, 245. Right, 27, 245. Big blocks of short calls. So these appear to have happened in reaction to this deep in the money put trade, because that's when we first got our lull in that big deep in the money put trade. It did pick up later in the day, but this all happened at the same time. So these blocks look to have been coordinated. So somebody came in and sold this entire, like all of this whole big block of short calls was all sold all at once toward the end of the day at 245. So that's not bearishness off the open. That's a really short bearish bet that looks to have been either a single trader or it struck me as possibly an institution attempting to sort of box us in there to kind of, I think a term I used in the article was kind of put some molasses right above us. So I want to talk about that in terms of our gamma exposure. Right, Max Payne. I did say it was initially showing as 27. Right now, it is showing it moved down to 26.50. So it has moved down a little bit. That's an important sort of addendum to put there. Again, looking kind of overall, not seeing too much difference if we go across all strikes. A lot of that is characterized by what we have coming up, say for June OPEX. That's sort of and May OPEX and June OPEX. But if we look at just this week, right, what really looks to be the case is we have this real concentration of gamma between 29 and basically 25.50. Really 26. Really 26, not even 25.50. So 26 is now mostly short calls. 26.50 now mostly short calls. Like way overwhelming. So we've got basically predominantly short calls stacked up at every single strike all the way up to 29 above us. So 26 is primarily short. 26.50 now is primarily short. 27 is primarily short. 27.50 is primarily short. 28, right? So we talked about this at the beginning of the week. 28, 28.50, 29. All of these are primarily short call positions. So what does that mean, right? This means a trader is taking on negative delta and negative gamma onto their books by opening this position. It means that the counterparty, the options market maker, is taking on positive delta and positive gamma. In order to hedge these positions, the options market maker is selling shares in order to offset that positive delta and positive gamma on their books, right? Positive delta, positive gamma needs to be offset by negative delta, negative gamma. So they're going ahead and they're selling shares of the underlying. So as we go up, those positions are increasing in terms of their delta values. It means shares are being sold with that share selling peaking as these contracts go into the money. Right. That's when gamma value, right? So the rate of change of delta peaks right when these strikes go into the money. So what appears to be the case is in the short term, this seems to be something of a low risk way of slowing down any sort of move that goes to the upside. So thinking about what we're seeing on some of our technicals, especially with respect to what Ultimator's indicator, possibly Richard's ETF model is suggesting, what might be on the table as has been sort of I've been able to intimate from Ultimator's post over on Reddit here with respect to interest rate swaps, we may be seeing some appreciation in the underlying via these repositioning factors. Okay. If in fact, right, things go as expected and we don't get the rate raise, then this short gamma here, these short calls, right, so this dealer long call exposure will likely result in a slowing down of whatever momentum that happens to bring. So, I've talked about that for a while. It does look like, right, we've got this kind of hedging dead zone at 29.50 here. Right, 30 is kind of weak. We do have the $30 call wall next week, sort of hemming us in there as well. So it does seem like it's possible an institution is opening these positions in order to, I guess, harness or recruit the options market maker to hedge in such a way as to resist upward momentum, to quell upward momentum if we do see that kind of episode. I think if we do see something sort of unexpected, if we see a rate cut, that may blow some of this out and sort of set us up for something like what we were seeing over in, it's just different than November, right? Because we had so much in the way of long call OI, trader long call OI at and above 30. We don't really have that right now. So the options market is not really set up for that. Although I will say we're going into an OPEX, we're going into a monthly OPEX. June OPEX also does have a pretty big buy skew on it. So, right, what does that more or less tell me? Well, I think there probably is. I think there's a decent chance that what we're looking at, right? So, I think there's a decent chance here that we do see some kind of upward price action. So some kind of recovery from this a couple day dip here, but I don't think in all likelihood that that's going to extend much beyond that 29 level. I think potentially we just sort of go back to the level we were, slowed by this positioning of short call gamma, trader short call gamma, dealer long call gamma, right? So that I think is possible. I think that's likely. I mean, based on some of these indicators that we're seeing here, I think there's a decent chance of that. Doesn't mean it has to happen, but I think there's a decent chance of that. But right, also staying wary that if we basically get what's expected, we've got the sort of roaring kitty requel rhyming dates coming up. I see a lot of posts over on Superstonk about this, right? People getting stoked for, maybe there's some kind of ETF covering thing. I mean, that seems to be what Richard's model in particular is attempting to account for. Maybe we do get some action, on that front. But, some people posts that are saying like, oh, the 12th, it's going to be the 1 year anniversary of the requel, and Maureen Kitty's posts like, oh, the 12th. I wouldn't be surprised if actually, right, if things basically go as expected with the interest rates, we'd see some of that bullishness now. People would get excited about the weekend, and then coming out of the weekend, smack, right, or splat. Not to say that would, ultimately in the longest time frames for the company is bad, or that I'm endorsing some kind of bear thesis, but I could see some kind of a rug pull that would be meant to, use kind of this interest rate swap bullishness, maybe some of this FTD covering that's related to things from the end of March or beginning of April, to see some of that take place. But then, be exploited as a way to sort of cheat short-term hype, to exploit some of this short-term hype that gets overly excited about sort of just rhyming dates with Roaring Kitty's requel last year without really taking into account the mechanical and causal factors that really drive this type of price action in the market. So I'm very wary of that. That's my outlook overall. But I wanted to break down essentially, why I think this is the most likely scenario, what we're looking at. We'll have to see, right? I mean, just, this is not an exhortation to trade the stock. Please exercise caution no matter what you're doing. Please read my disclaimers with respect to options. I'm just excited to see how this plays out, and certainly to continue to investigate this thesis with respect to interest rates and how that has and how that may still yet play a very large role in understanding our price cycles going forward, especially in this new sort of bullish chapter in the life cycle of the number one stonk. So thanks very much, everybody, for watching and listening. I'm sure this is a topic that we will get to into some greater depth on live stream this Friday after market hours at 4 p.m. 4 p.m. Eastern Daylight Time. So look forward to seeing you guys there. Look forward to seeing you, throughout the day in the comments and whatnot over on X, here on YouTube, and as well as in our videos for the next couple days. So thanks very much, everybody. Look forward to seeing you soon.